Hello everyone, in our previous video, we talked about the time value of money and interest. Today we will focus on inflation, deposit interest, withholding tax, the relationship between inflation and interest, and real interest rates. If you watch this video without watching the other one, you won't get the full benefit. So please watch the first part first. Now, let's get started with our video. First, let's answer the question of what inflation is. In simple terms, inflation is the increase in prices of a shopping basket that includes basic necessities. More specifically, it is the continuous and noticeable rise in the general price levels of goods and services. Inflation can also be tracked through the Consumer Price Index, CPI. It can be measured on a monthly, yearly, etc. basis. This increase leads to a decrease in the purchasing power of money and is generally associated with economic growth and an increase in the money supply. So, what is nominal interest? Nominal interest is the interest rate announced by banks, which is not adjusted for inflation. This means that you cannot calculate what you will receive in the future for giving up the right to use your money today based on the nominal interest rate. First, inflation must be subtracted from the nominal interest. A deposit account is an account where people invest their money to earn interest, or more precisely, to preserve the value of their current money. The government deducts withholding tax from the money earned through these accounts. This means that to determine the actual return on your invested money, you need to subtract not only inflation, but also the withholding tax. The value obtained by subtracting the withholding tax from the nominal interest is called the net nominal interest. Now, I want to explain the relationship between inflation and interest rates. At the same time, we will also learn about real interest rates. If the expected inflation rate during the period you deposit your money is higher than your interest rate, then negative interest rates prevail. This means that your money will lose value because the depreciation of money over time is higher than the interest return. In this case, it would not be logical to invest your money in interest. If the interest rate is higher than the inflation rate, then you will have a gain greater than the value lost by the money. In this case, it would be logical to invest your money in interest. The important point here is not the current inflation rate, but the expected inflation rate during the period your money will stay in interest. As you might expect, the real interest rate is the nominal interest rate adjusted for withholding tax and inflation. So, how can we calculate exactly how much money we will receive in the future when we deposit our money into a deposit account? That is, when we invest in interest. In this case, we need to find the real interest rate. The formula is as follows. We subtract the product of the nominal interest rate and the withholding tax from the nominal interest rate. The value we obtain is the net nominal interest. Then, to adjust for inflation, we subtract the expected inflation from the net nominal interest and divide the result by 1 plus the expected inflation. The resulting value is the real interest rate. The real interest rate will show us how much return our money deposited into the deposit account today will yield in the future. Today, we explained the relationship between interest rates and inflation. We hope you have found this section of our free finance course to be informative. If you have any questions, please leave them in the comments. We assure you that we will answer all of them. If you liked the video, don't forget to like it. If you didn't like it, feel free to dislike it. Also, remember to subscribe to the channel and turn on notifications so you don't miss any videos. Until next time, take care.